The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and thank you for joining our webinar today for our 2018 investment update. Throughout this webinar, we hope to increase your understanding of what's been occurring in markets with the recent volatility, what we expect in the year to come, and a little bit about our investment process here at the center. Last year was a quiet year with markets marching upward with minimal hiccups. The S&P 500 was up every month in 2017. This year has turned into a very different story, though. I'm Angela Palacios, the Center's Director of Investments, and joining me today on the webinar is Melissa Joy, Partner, Planner, and Investment Committee Member here at the Center for Financial Planning.
Hi, Angie.
Thanks for joining. Before we dive into the presentation, I'd like to note that this webinar is not open for questions in real time. However, if you do have any questions, please email Melissa or me directly following the webinar, and we'll be happy to respond to you. You can also visit our website for more information and upcoming webinars. So I'd like to kick the webinar off and just address the elephant in the room, what you're all probably thinking about. Late January, investor sentiment shifted from investors worried about missing out on the bull market to concerns that markets were overbought. Melissa, can you comment on what may have caused this sudden shift?
Well, I think that the first thing that you should mention is diagnosing a recent kind of market ill can be challenging. You may miss some big important kind of components of complexity when you try to simplify it down to a few bullet points. Nevertheless, here are the bullet points that I'm kind of focusing on when I think about what's been happening recently. First, it is pretty clear that there was a really negative reaction to some decent economic numbers that came out around February 2nd, which was a look back at January's employment picture, where things looked good. We were getting, similar kind of job creation as we've been getting throughout this recovery. But then there were also reports that people's wages were going up. And if you and I think about how you think about that information as an individual, you're thinking, great, there's more money in my paycheck and those of others, which means that we can contribute more to the economy plus have better personal financial situation. But inflation is something that has really been missing, and when you think about a wage pressure, that's an important source of inflation. It's something that has not been prevalent in the market, and while it's something that many have wanted to show a health in terms of recovery, it's difficult to tame inflation once it exists, and it's also new. So it's something that we've been waiting for, but it's brand new. So you can think about the first times when bond yields started to bump up a few years ago, where there was a big reaction right off the bat. One of the time periods was the taper tantrum. I don't think it's that dissimilar, that the first time you kind of get those green sprouts of inflation, that there's going to be some adjustments. Nobody likes change, whether it's personally or in the markets, and that definitely is something that we need to factor in. Then also, at the same time, we have this impasse in terms of the ability to do a budget deal, which hopefully is resolved at this point. But that, set a tone in January that in past markets has been something that would typically be negatively received. It wasn't negatively received over the course of 2017 when there were the same challenges in terms of political compromise and consensus. But we had an anticipated tax reform in 2017 that really helped with that volatility. And, there was always this carrot that if you just wait, we're going to get this tax package. There were a couple points in time where it didn't seem clear that it was going to be happening. But I would argue that the anticipation in 2017 really buffered any sort of market reactions to bad news. And without that tax deal, I don't think there's going to be as much of a, kind of just wait for that infrastructure deal, because that's kind of the next thing on the list. So I think that there was a different, more negative reaction to challenges with the budget, government shutdown, etc. Bond yields have also been rising. So while you would note that the year started off good for stocks before you got a few weeks in. Bonds really took a hit. It's probably been buried in the headlines overall. But those bond yields that are rising, which are going to go in tandem possibly with inflation story, are an important consideration as well, and that's something that the market's trying to understand and digest, and you'll find that for the more heady kind of investment prognosticators that's something that they feel is shifting. And then the other thing that I would mention is that we had, and we're going to kind of circle back to this in our conversation here today, but we had very, very low risk and volatility in 2017 markets, and then it's kind of changed hands with very high volatility over the last couple weeks. And both of those, I think, have to do somewhat with feedback loops that are built in when you have more kind of computer and automated trading. So while any reaction, might have been a bad day, they started to compound upon themselves over the weekend from that first Friday where things were significantly down into the big bad day where the market was down more than it had been, in excess of 1,000 points in the past. So all of these kind of are combining and we're still asking more of the why, but we want to talk a little bit more looking forward too. So, Angie, I was mentioning volatility, and we've both been talking about this with client meetings. When I look at the measures of risk in investment portfolios, and I was discussing this with clients prior to the past couple weeks, we were just seeing completely still waters throughout 2017, something that in the 20 years that I've been working with investments, I've never seen before in terms of how low the risk was. It was very noteworthy. So when you look at this chart and you can see that the yellow band is typical volatility, almost always double digits for US stocks, even higher for other types of equities. Of course, lower for bonds. The volatility of stocks was looking like a very low volatility bond environment.
Yeah, unreal.
Yeah, very unusual. And we knew that there was going to have to be kind of a reversion to the mean. So while we tested those very low volatility waters, then we went to the complete opposite end of the spectrum. Now our question is, we're going to observe and see, okay, what's going to happen in the interim? Are we going to go back to kind of a normal volatility environment? I'll be frank, it would be great if we could have just no volatility all the time. But what we know as investors is there's at a certain point you do revert to the mean. So the longer we'd extended that kind of Goldilocks environment, the more challenging we think it might have been to kind of unwind that, both from a behavioral as well as a technical sense. So that is something to note, that we don't think it's all bad to kind of return to a normal environment. Let's see if we can get to normal again.
Yeah. So I'd like to step back with a little history lesson here. Blogs are great because they're kind of like a journal, and we've been writing blogs here at the center for about 6 years now. And one of the earliest blogs that I personally wrote was about the lost decade. If you remember, investors were very nervous to invest in the U.S. because it had basically provided flat to negative returns for the past 10 years when you were standing there looking at returns in 2010. In these other asset classes, international markets, commodities, real estate, had all done very well over that time period. So if you fast forward to now, you see that we've really experienced an amazing decade since this lost decade for the U.S. markets. The S&P has shot up with really minimal blips until just recently. Pretty incredible, though, looking at this chart just to see how far we've come since that lost decade. We've gotten very used to seeing green all the time on our statements, so it was really shocking to finally see some red start to creep back into the markets lately.
I think it's interesting, too, that people were very skeptical about that recovery, whether they were professional investors or personal investors in the beginning. And now it seems like old hand. It's been almost 10 years since we had, the real disruption that came with 2008. It seems like it was yesterday in a way, because we didn't really leave that sentiment for several years, 3, 4, or 5 years.
Right.
And that uncertainty and skepticism is what builds and breeds good markets like we've been able to have.
I agree. If you've listened to our webinars before or had meetings here with us, this probably isn't the first time you've seen this chart. It's really kind of an extension of the last two charts as it plots out the S&P 500 performance, which is that black horizontal line you see across the middle, versus those other diversifying asset classes like real estate and commodities, different things we talked about in the prior slide. It shows how over the past 5 years, really nothing, very, very few things have been above that black line, meaning not much has outperformed the S&P 500. So the question we heard through 2017 pretty consistently was, why don't we own more U.S.? Think back to my last slide and how our moods have changed from kind of worrying about that lost decade to wondering why would we own anything other than U.S. We should own all that now. This was especially true during 2017 when the S&P was positive every single month of the year, which hasn't actually happened since 1926. But just like it was our job back in 2010 to help you understand why holding on to your U.S. large company positions was important, now it's our job to remember that and help you understand why you want to continue owning your bonds or maybe your international investments through the last 5 years. So at this point, we're looking at rebalancing portfolios kind of back into bonds. We've had kind of slower bond performance over the last 5 years or so, and they've become kind of underrepresented in many portfolios. So if you wonder kind of why those bonds are there, I think the recent markets are a very good reminder. Noah didn't start building the ark when it was raining. By that point, it would have been just way too late. So why would you wait until the markets start going down to make sure that you're properly diversified and have, that bond bucket kind of filled up to where it's supposed to be for you? So you never want to wait until it's too late.
I'd also mention too that we have kind of 2 layers of allocation components within our portfolios. There's the allocation that we recommend based on your investment needs and preferences combined with our investment committee's best ideas. And then we do incorporate managers who think about the mix of stocks and bonds that they want. So there is some active management overlay within the individual selections of many of our clients' portfolios. So that you see is underneath, kind of under the hood. So it's not something that is obvious to investors unless they understand our process.
Yeah. So we want to jump into talking a little bit about our outlook now, Melissa.
Well, I've got to give kind of a qualifier when we think about the future, in that we don't think we can forecast markets. We do think we can have some good information about where we're at today, and of course, hindsight's 20/20. But when we look forward, in most cases, markets go up, and this is a look at numbers of where the market will go based on different time periods. Was the market down last year? And in that case, were you more likely to go up the next year? Was the market up like last year where we had a 20% up year? And really, if you take a very long data set going back to 1897 and say in any given year, what are my odds that the next year will be good? About 2/3 of the time, regardless of what happened most recently, things are going up. And in fact, I think that's part of a reinforcement for the types of discipline that we think will result in sound kind of investment strategy in order to meet client financial goals. We want to remember that crystal balls are not for investing.
That's right.
That said, we do, also have some outlook and themes that are important to us. And I would start with, Angie, you've mentioned how good the U.S. large company stock market has been. This is 2 examples, and if you look on the left, the blue line that's going up, you can see is the returns of U.S. large company stocks over a very long period of time since 1926. The yellow line is a trend line, so on average you get about 6.5% returns over this long period of time. And we've just crossed over that trend line into an area where we're doing a little bit better than the average. That can last for a long time. So if you looked back to the 90s, there were many years where you were kind of above that trend line. So you don't want to overcorrect based on, any crossing of the paths. But what we do know, if you look on the right and all those dots, is that it's about 50-50 between plus or minus returns when you're at this type of point in the trend line. It's not a point where you're going to bail on all of your strategy, and this is the returns over 5 years, not 1 year. But we're feeling like U.S. stocks are at or near the higher end of their valuation, and that's something we've been talking about for a while.
So that's the U.S. market.
So that's U.S., and it's not the same for everywhere, right? So this is a combination of the rest of the world in terms of their stock markets. Same trend line. It doesn't go back quite as far because we don't have the data sets for international stocks really start in the 70s. But what you'll notice is there's been many periods of time where international stocks have been, kind of above their trend line, but that is not what's taking place recently. So most recently, and this fits back into how did everybody do, kind of stacking up their ranking versus US, international has been out of favor. And so there's a lot of room for those valuations and the price or the returns of international to kind of catch up with their averages. And when we see, again, with the same scatter plot on the right for the next 5 years of the returns, we are at a point where returns are much more typically north of 0 and in a much more attractive range. So that's something we've taken note of. We've taken note in terms of how we recommend constructing portfolios, and it's something that's not new. This wasn't a decision or an observation over the last few months. It's really a couple years old, but it's something that we've been trying to articulate within portfolios and recommendations.
Definitely. I think it's interesting to mention too that over the past 60 years or so, the U.S. and developed international stocks have consistently had this pattern of 5 to 7 years of outperformance by one, followed by kind of the next 5 to 7 years, the other outperforms.
Yeah.
So they do tend to go back and forth with each other. So what are some other themes that we're thinking about, Melissa?
Well, I'm going to mention a theme that is not a reaction to the current market environment, because I do think we can so easily get trapped in a short-term theme. But longer term, what we're hearing from many investors, and it's not as adopted within the professional investment community as it is personally something that's appealing to individual investors. There's an attraction to social investing. We call it ESG, or environmental, social, or governance. But what it kind of drills down to is companies that do good things for either their customers or clients or their employees, or maybe both, and measuring that, observing that, and then some studies more recently say that can result in better results for the overall kind of corporate profits and performance of the stock. So I wanted to take the opportunity, because this is something I would have been talking about without kind of the volatility within the last couple of weeks, to mention that this is a strong theme, and the demand for these types of investments is growing from people as clients, and it's something that we've developed in terms of the ability to invest with the same center investment process that we use for any portfolio.
Yeah, it's always great when you can align kind of your values with your dollars.
The other things that I'm thinking about that we talk about in our investment committee, Angie, and we're all, kind of are top of mind. One is that there are many more opportunities to reduce the cost of the internal expenses of investment portfolios, depending on which investments you select. And there's a lot longer data sets of how those types of investments, whether they're exchange traded funds or lower cost indexes, behave when they're kind of paired with the more typical investments. And so that ability or opportunity to reduce costs within the portfolios is something that is ongoing. And I think it's valuable to have information based on when markets decline, as there are so many newer kind of investment options available. Also, I mentioned that tax reform, there was a prelude to tax reform for much of the last year, kind of a golden head or golden tailwind that everyone was anticipating. So now we have actual corporate tax reform. We think it might benefit mid and small companies a little bit more. And also we need to figure out what that means in terms of money crossing borders, etc. So that is something that is definitely relevant. It's both relevant on a personal financial planning level for our clients, especially if they're business owners, but also let's see how much of that can result in stronger returns for companies. And then one of the themes that is evergreen, but is most important to talk about in times of volatility, is that financial planning is what builds your portfolio for all different types of markets. So when people say, what's the plan? We didn't, what's going on because we entered correction territory as the markets declined 10% intra-year. We have to remind clients that we anticipate that portfolios will have both ups and downs. The best way for them to be a participant in long-term possibilities of portfolios is to remain an investment participant throughout those ups and downs. And our financial planning process has given us and them the information needed to know that they can stick with that plan through those times.
Mm-hmm. So I want to think about, we talked about a little bit about our outlook. I want to turn the conversation to just some things that we think about in investment committee meeting and things that could potentially keep us up at night. But first for me is, a trade war. We've seen some kind of baby steps taken here with washer and dryer imports, having tariffs added to them. And since then, major providers like LG and Samsung have already announced price increases. But whenever you restrict the flow of goods and services, you risk causing inflation. So currently the U.S. is negotiating trade deals with all three major trading partners, China, Canada, and Mexico. And compromise is highly likely, but the U.S. and China are both kind of adopting a tough stance. So this could be a source of volatility for markets as it plays out. The geopolitical scene is another topic that is kind of always a topic at the front of our mind because it can crop up and cause market volatility at any given time. These types of topics are really difficult to model into investment decisions because so little is actually known until something happens. But some of the concerning topics that we're keeping our eyes on include areas of the world like North Korea, maybe more terrorist attacks in Europe, Ukraine-Russia conflict, populist elections in Europe. So there's never any shortage of these types of topics to worry about.
I'd mentioned too that while it's not a political one actor deciding to do something surprising to another, there's also, the global, natural disasters to factor in. Mm-hmm. So you had last year significant hurricanes that made a big impact on local economies, and you can't predict where those will happen either. Often it's what's not on your radar that becomes the biggest and most shocking. So, those possibilities seem to pop up more and more often as well.
Yeah, they sure do. Another topic, we've talked a little bit about already is inflation. Up until just recently, it had kind of been a mystery. Everything the Fed had done with quantitative easing should have really started to spur inflation, but it hadn't until those kind of most recent reports. So something I think about, that's really interesting is kind of how we measure inflation itself. We could need a little bit of an overhaul. I think there are things that we just aren't taking into account. Like you think about Hilton. It's a known brand hotel chain. It took them 100 years to provide 700,000 hotel rooms for rent. And this growth is countable. Ground was broken to build these hotels. People were employed. Materials were bought, and then they're rented out. Well, then Airbnb steps on the scene, and within 6 years, they're providing over 1 million rooms to rent. Well, where was there anything to count? There wasn't anything to count in inflation or GDP. It was just all of a sudden you took this unproductive asset, which is our homes, and turned it into kind of this income-producing entity. So there's really no way to count this growth the way we measure things now. So other than, it probably has a deflationary effect to hotel prices, or maybe puts a ceiling on them in certain areas. But finding ways to use current assets more efficiently isn't something you can easily count in GDP or inflation numbers yet.
I think that's a good, example too, that there's the possibility of disruption in terms of old business models more and more. That's one great example where, this weekend when we go up north skiing, we'll be at, an Airbnb or
right,
providing fuel to the gig economy. Same goes for other parts of things where we are very used to a business model that's worked for 100 years or more.
Mm-hmm. And another item, we think about are kind of an unexpected spike in bond yields, and Melissa talked a little bit about this too. While bond markets are expecting several rate increases by the Federal Reserve this year, if the increases happen quicker than expected or maybe go farther than expected, we could see some market jitters because of this. We now have a new Federal Reserve chairman that was sworn in early February. Plus, there were many seats the board vacated that are in the process of being filled. So this all adds to a little bit of uncertainty in the bond markets. A new makeup on that central bank board could bring some concerns if they deviate largely from the path that Janet Yellen laid out.
And, I think that there has to be some point where the cat and mouse game where markets can have a little bit of a fit in order to stop the Federal Reserve from their anticipated rate raises to normalize interest rates. At some point, the Fed has to call the bluff of the markets. And so that's something that it'll take, a time or two to get used to, and it will be quite interesting to watch. Now, you may be very concerned after you've just heard about all of the reasons why things could go wrong. And I think that is a great time to remind people of a process that's worked over time and is built to be working into the future, which involves discipline around investment decisions. Angie, could you share a little bit about how we make decisions and how we manage portfolios and how it's common practices for good investors to make those decisions?
Absolutely. We often receive questions from clients on what exactly do we do with your investment portfolios? How do we manage them? Last summer in our webinar, I talked a little bit about how we select investments for your portfolio. This year, I wanted to take a few minutes and just step you through more of kind of the practical side of our investment process for not only a new client, but also for clients who have been with us for many years. I'm sure many of you are aware of the term rebalancing. It's not a new concept. It's basically the process of taking money from one overweight portion of your portfolio and reinvesting it into an underweight portion. What you don't probably know is how we do it and what prompts us to make a rebalance. All of our clients are set up in a software that analyzes each of your portfolios every day and gives us a report of what needs attention. As you may or may not know, we serve over 950 families here at the center, and watching each and every portfolio would be nearly impossible without either a lot of staff or with the help of technology. So it's really the inputs, though, that drive the nature of what we do for you, and that's where the human touch comes in. So first, with the help of your planner, you determine what your strategic allocation is. And in its simplest form, the strategic allocation is just the percent of stocks, bonds, and cash that you own in your portfolio. Occasionally, our investment committee, as Melissa alluded to earlier, may choose to apply kind of a tactical over or underweight, maybe some international opportunity out there, so we want to weight a little heavier towards that area. But any strategy that utilizes this kind of strategic or tactical allocation also has to rebalance. It's a very important part of that process. The question isn't if, but how. So there have been a lot of studies within the financial planning industry showing the additional return benefits to a portfolio of regular rebalancing, and now it's become kind of this generally accepted fiduciary concept. So there are several reasons that prompt a rebalance or a change in your portfolio, and that can be things like cash deposits or withdrawals, an investment committee decision to change something, maybe growth in market, some markets more than others. And there are several ways that we can rebalance your portfolio. We could do it regularly on a calendar basis. We could use these cash flows coming in or out of your portfolio, or we could do it opportunistically. Looking at like cash flow rebalancing, this is something that we use regularly for accounts that have cash kind of moving into or out of the accounts with some regularity. When you establish an account, we add money to all of those different investment buckets that you see on the left-hand side. So once the money's invested, let's say we have a year where the S&P 500 is down 30% and bonds are up 8%. You really have to look at this point. Maybe you've received a bonus from work, or you want to make your yearly IRA contribution after this has happened. So if we have cash flowing into the account, we'll purchase the kind of asset class that is most underweight. In this example, you could see that bucket there on the right that's not quite as full as the others, U.S. large cap. So money that would be flowing into the account would be going into that area because the S&P 500 had maybe more challenging returns in the prior year than the other areas. On the flip side, if you're taking money out, maybe an IRA distribution for your living expenses or a down payment on a new home, for example, if a cash distribution is needed, we would look at that kind of bucket that's overflowing. So those core bonds that had a really good year last year would be overweight compared to everything else, and that's where we would sell to take some profits and raise that cash. So in this case, you can see that really the cash flows are what prompt a lot of the rebalancing that we do here at the center. You may wonder, if you're not actively depositing or withdrawing money, how do we do that? Well, we do have a way. We can set up investments, and we do. It's kind of our standard practice to have dividends that spin off from your investments to pay into cash in the account. So we use that money, we let it accumulate a little bit, and then we reinvest it in those underweight asset classes. So even if you aren't actively depositing or withdrawing money from your accounts, we have kind of a little more tax efficiency built into the way we can do that rebalancing. So the last kind of rebalancing that we do is it's an opportunistic rebalancing. It has a lot of names, but that's one of them. We look often, but we really rebalance infrequently. So studies have shown that monitoring accounts frequently allows rebalancing to occur potentially at the most opportune times, capturing these little potential sporadic buy low, sell high kind of opportunities. When we help you determine your strategic allocation, we also assign a set of drift ranges, so a range that portfolio can drift before it prompts us to rebalance. So let's say, for example, if you wanted to have 70% in stocks over the long term, we might let that drift up as high as 80% or as low as 60% before we would prompt a rebalance. On a more granular level, this actually shows also how we can let our different buckets or those asset classes drift as well. So if international large cap, let's say we have a target of 10%, an acceptable range on the right-hand side may be down as low as 8% or up as high as 12% before we would trim that position or buy more. So that's what we call kind of range or threshold or opportunistic rebalancing.
I think those ranges are important because they allow for the natural momentum of trends to play themselves out, and that's what the studies seem to indicate. But additionally, over the last year, when any new money came into the portfolio, whether it were from dividends or deposits, then that was going more toward bonds. And when we needed to pull from things, it was coming more from stocks. So that was like a natural precursor, keeping things in line as you'd had a pretty, momentous market return.
So, Melissa, can you wrap things up here a little bit with some final comments?
So we've shared outlook and we've shared process, and I wanted to take a couple of my favorite headlines. I just took some pictures with my phone as I saw them over the last couple of weeks. These are mainly from just after that big 1,000+ point down day. So when you look at the left, you can see first, the stock market didn't get tested, you did. Well, gosh, I love that headline because it really gets back to our overarching theme, which is control your behavior. That's something that's within your control, and that's something you've hired your financial planner to work with you to do. And then in the middle, even Stephen King has some market commentary. How much did the Dow drop today? 666 points. Let me say it again because I don't think it's a coincidence. So, everybody likes to have an opinion when markets are in headlines. And certainly media organizations know that the possibilities of you clicking so that they get ad traffic are higher if they get your attention. Look at this headline. Stocks soared 21% in a year, and then this week happened, like it's all erased. There is so much potential for you to think in a very short-term time period. I heard, I saw things that indicted, we were promised this returns from tax reform, and now in this week it hasn't happened. There's so much short-termism that really comes into play when you are naturally, in a time of volatility, especially when you haven't had that in the past. So focus on the things on the right. Plan, don't panic. Rely on your financial plan to ensure that you can continue with the discipline that is required to be a successful investor. Manage your cash. Now that means have conversations with your financial planner about cash you anticipate using in the near future. Also, keep putting your cash to work when it's available, whether it's contributions to your company retirement plans. Embrace the opportunity to buy your next deposit at a cheaper price than you bought your last deposit. Stick with process and discipline. So you picked a strategy for how you're approaching investing, hopefully in conjunction with your financial planners, that should work over time and especially over longer periods of time. So don't bail on the strategy at the moment that it's easiest to kind of have your doubts. Keep rebalancing. I think, Angie, you had a great explanation for kind of how things work. Keep it up. Control the costs that you can control. So be conscious if you're in a higher tax bracket of tax costs of your investment portfolios. We're certainly looking at portfolios when they're taxable and saying, are there some tax loss selling opportunities that we can take on? But overall, manage your behavior. If it's becoming difficult for you to stick with a plan, have a conversation with a financial planner. If you don't happen to have a financial plan, get one, because that really does elongate kind of the possibilities of you sticking with a program that over time is able to work.
So to wrap things up, we'd like to thank you for joining our webinar today. It's been our pleasure to share our thoughts and the latest market updates with you. If you have any questions, feel free to reach out to Melissa or myself, and we'd be happy to talk to you. Our contact information is on the screen, and I'd like to direct you to our website if you want to look for any future webinars or upcoming events or any blogs that we've written.
Thank you for your time. We appreciate it, and please don't hesitate to reach out if you want to continue the discussion on a personal level.